New data from Domain shows house prices are falling in Sydney and Melbourne. Its latest quarterly house price report shows prices fell by 0.04% in Sydney, meaning the median house price now sits at almost $1.8 million, ending 3 years of continuous growth. A slump of 0.6% was recorded in Melbourne. Prices in Darwin, Perth, Adelaide, Hobart and Brisbane all increased, with the Tassie capital recording the strongest quarterly growth in more than 4 years. Agents have reported the slowdown in Melbourne and Sydney happened over a period of weeks, not months, with the major cities hit particularly hard by global economic instability. Well, let's bring in Domain's Nicola Powell for a little more on these figures. Nicola, thanks so much for joining us this morning. So, look, house prices in Melbourne and Sydney have fallen. Those two cities are typically, amongst the most expensive. Why are we seeing falls there?
We tend to find that Sydney and Melbourne are much more sensitive to changes in the economy and also changes in the cash rate. And what that means is when we go through periods where rates are rising or they're falling, it does seem to be amplified through these housing markets quicker than other major capital cities. And I think that what we have seen is a real change in conditions. We are in a period of uncertainty. We are expecting more rate hikes this year. And that is playing out in a more cautious buyer across Sydney and Melbourne housing market particularly. And these are two markets that have now started to see supply rising. So overall choice now in Sydney's housing market is about 5% higher than this time last year. So that is good for buyers, and buyers are realising this, so they're taking their time when it comes to their purchasing decisions.
Meanwhile, particularly in Sydney, we're seeing house prices falling slightly, but unit prices are jumping. What does that say? What does that sort of tell us about the situation and what buyers are doing here?
So we do almost have a dual market now in Sydney, and even in house prices, we've got more affordable areas holding up and still growing in some suburbs compared to those more middle and more expensive suburbs. I think the difference between houses and units in terms of their performance, because they're pretty much going in opposite directions, really says a lot about stretched affordability. I think with expanded first home buyer schemes as well, bringing first home buyers to market, that helps to support demand in the unit sector across Sydney, but it also is coming out in house prices at the lower end of the housing market. So think those western suburbs, these are areas where they're still seeing house prices grow.
In Tasmania, Hobart sort of seems to be playing catch up a bit here. House prices have jumped by 4.7% there. What are you reading into those numbers?
Some of the increases that we've seen in our other capital cities, and this is largely dominated by our smaller capital cities, but some of those mid-tiers as well. Hobart is one of those examples, but this was a market that had really struggled and gone through a real period where it was sluggish. So I do think there is an element of catch-up here. It'll be interesting to see if those conditions hang around, because when you think about the cash rate and the outlook for where mortgage rates are going to go, it has changed significantly. I don't think anyone expected two back-to-back rate hikes that's already been delivered this year, and now we have the expectation that the RBA will hike again next week. And I think that outlook might dampen activity a little bit in some of these smaller capital cities. And what we might start to see is growth still there, but at slower rates than what we saw over the first quarter of this year.
Pressure is also building on renters. We've seen figures out of WA this morning, Anglicare reporting that rents are up in WA by 10% on last year. What do these changes in the buyers' market mean for renters, do you think?
We'd still have a very strained rental market across Australia, and all of our major capital cities are operating in a landlord's market. What's interesting, though, is the pace of rental price growth has slowed down, particularly so in a market like Sydney, where we saw it flatline over the first quarter of this year. And I think that says that tenants really have reached their affordability ceiling. But I think when you look at the sales market, what we've got now is it is slowing down. Not across every capital city. Markets like Adelaide Adelaide are still accelerating in growth. But I think when you look at conditions, particularly in Sydney and Melbourne and some of those cities that are starting to see slower rates of growth, I think it does present an opportunity. When you have peak uncertainty, what that creates for buyers is peak opportunity, and it also creates a market that is moving slightly slower. And when you're purchasing a home, making a decision when the market conditions are slightly slower means that you're making a more informed decision, and you can take your time when it comes to purchasing a home.
Nicola, you've touched on this a little bit already, but we are, of course, expecting to see rates hiked again next week. If I can get you to put your crystal ball on, what might that look like for the market?
Look, I think we're pretty much all aligned that we'll see the RBA hike the cash rate next week. I think what we're likely to see is further slowdown in our housing market, particularly so in Sydney and Melbourne. So I do think the first quarter of this year and those marginal falls we saw in our two biggest capital cities is just the beginning. And I think what we're likely to see this year is much more slower conditions. We might see some of those mid-tier cities still grow, areas like Adelaide, Perth even, and Brisbane. But I do think that what we're likely to see is further falls, particularly so in Sydney and Melbourne. We've got to remember this impacts borrowing capacity, and you've got the market now pricing in 2 further rate hikes this year. If we see that materialise and you look at the 2 rate hikes we've already seen, that means you're going to have a borrowing capacity about $100,000 lower than what you would have had last year. That will impact the market.